Hello everyone, my name is John Locke. I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we're using hypothetical computer-simulated trades and results. Trades and results are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance wealth coach and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today I'm here to take you into the realm of high probability options trading. Now, high probability options trading, also known as income trading, is where we utilize the passage of time in order to help us make money rather than depending on price movement alone. What this means is that we can often make money whether the price goes up, down, or sideways. That doesn't mean we're going to make money all the time, but it does mean we have a much better chance of making money than if we were to simply go with a directional bet. And today, I'm here to share with you a more subjective strategy than usual. Most of the time when we talk about the winning trade, we're talking about our non-subjective income strategies where we essentially pay no attention to market conditions and we just do the same trade over and over again. What I'm going to show you today is kind of a cross between a subjective trade and a non-subjective trade. So it's somewhat non-subjective, but I do throw a little bit of curves in there. And what we're going to be doing is called a professional style income trading. This is where we increase our returns and consistency through trading with the flow of the market and utilizing trader subjectivity with very high probability trading structures. It's extremely effective and it allows us to trade with flexibility and adaptability. And by doing so, we can make more money with less work and fewer adjustments. And it's the way that I encourage our traders to aspire to, and it's what we do within our Pro membership. And I encourage you to take a look at our Pro membership if you become interested in this type of trading. So the type of trading strategy we're going to cover today, or the type of income strategy we're going to cover today, is what I call a short-term, short spread calendar. And we're going to be doing it in a bit of a subjective manner. And what I'm going to do is we're going to set some risk parameters, and then I'll talk about the strategy a little bit. So the maximum trade size we're going to have here is $25,000. We're usually going to start out with less than that. $25,000 includes adjustments. Our anticipated return on the strategy is going to be about 30% or $7,500. Now, when I do these trades, I do not have a profit target, but whenever we do a trade, we do want to understand what our risk and what our reward might be. So in this case here, I usually try to make about $7,500. I may make a lot more, I may make less, I may lose money, but we'll see where that goes, right? And our exit loss trigger we're going to use, this is about 10% of planned capital or $25,000. And again, the trade structure is what we call a short-term narrow spread calendar. If you go back to last year about this time, we also did a winning trade on a very similar strategy using calendars with a short spread and about the same time frame. And this being subjective, we've shifted things around a little bit because the implied volatility situation has shifted since last year. But as you'll see, still very effective trading strategy that we're going to show you. So what we're going to do here is I'm going to start looking at the options that are somewhere between 14, 16 days to expiration. And I'm going to look at selling the at-the-money options. And they could be calls or it could be puts. It doesn't really matter. You'll see sometimes I do calls, sometimes I do puts. They're synthetically the same position. So it's just whatever happens to be convenient at the time or the trade of the day, so to speak. So I'm going to come here at the money. In this case, I look at selling 10 puts. And then I go about 3 or 4 days out, depending on what your spread is. It's pretty much the minimum spread possible. And I come in here and I buy 10 of the same strike. That option strategy is called a calendar, and the expiration graph for that looks something like this. Unlike the butterfly trades that we usually cover, on the butterfly trades, the expiration graph is essentially etched in stone, so to speak. It doesn't change through the whole duration of the trade. On a calendar, the expiration graph changes depending on what the time premium is in the back month option, and it can fluctuate up and down, and it can fluctuate up and down quite a bit. So you have to keep that in mind. We're paying $3,520 for this particular trade. So that is our risk in the position. And as of right now, our potential profit is about $18,000. Now, I won't enter these all the time. I'm only going to enter these when it gives me a nice, what I would call a nice high tent. This actually is not a nice high tent, so it's kind of a marginal trade to put on. In fact, you'll see that the first couple trades, what I'm going to show you here is I'm going to show you all the trades of 2022. And this was the first trade of 2022. And the first couple trades were actually came out negative. But I just want to show you those because I'll show you how mild your risk is in the strategy. So here you can see we have $3,500 at risk, and we can have up to 25,000. So we start out with a very small amount of initial capital. Theoretically, we have a potential gain of 18,000. That could actually happen the way we trade this, because we do trade it pretty much right near expiration, and we could get near that number if the back month option stays up or goes higher. But we'll see what happens here. So what we're going to do is, and again, this is the subjective part, is when I start to get what I see is into trouble to the downside, I'm going to be reducing my risk to the downside. So I'm not depending so much on delta here, but how much risk I have with price movement. And the way I'm going to correct my risk to the downside is essentially move these down, something like that. And you can see that takes a whole bunch of risk out of the downside. When I do that, I generally don't switch my delta. So if I was doing this because I had positive 5 delta, for example, I actually wouldn't make this correction because it puts me to negative delta, and I wouldn't want to do that. I want to make sure that generally I keep the same delta sign. I will switch occasionally and not marginally, but normally we're going to try and keep that the same. And I'll do the same to the upside if it goes the other way. So let's just run through these. I actually have this year, we have, let's see, 1, 2, 3, 4, 5, 6 of these. This one's not closed yet, and we'll just show you those. So here I come in, and usually if I, as far as getting out of the trade, I'll get out of the trade if I have too much price movement risk. I'll get out of the trade if I'm on expiration day, which is usually how we get out. I generally won't get out because of a profit target, but occasionally I will if I don't think my risk reward is good. Again, it's a bit subjective. So let's move this forward here. So I'm just going to go to first adjustment. And by the way, right, it was a 14-day on my short strike, so it's a maximum of 14-day trade. So here, the market's pulling down a bit. We're down like $319. And to me, I have a little bit more downside risk than I like. The bigger parameter I'm looking at here is, can I make this adjustment with 5 contracts and actually still be positive delta? And in this case, I can. So I'm going to go ahead and do that to deal with the downside risk. Right. And this is what it looks like after adjustment. Usually with these two, if I get whipsawed to the upside, I'm out of the trade. It's done. If it's a mild whipsaw, I might run with it. But if we turn around and get a 100-point up move the following day, the trade's over. It's just going to be the end. We're just going to go to the next cycle. These are short term. You just re-enter if you run into too much trouble. So here is this trade or that adjustment. I'm going to take this off and go to the next adjustment. And I'm going to go through these kind of fast because we have a lot of trades. We continue to go down. So I can make another 5 contracts and still maintain my positive delta here. So I'm going to go ahead and do that. And once I get down so that the risk in this thing is under $2,000, I'm not really so much worried about it anymore. At this point, if the market continues, I end up taking a small loss on the trade in this case here. I don't remember. I think it was like $800. And that's what happened. But I do that for the opportunity of, say the market runs up a couple days, I can get up into this tent. And my potential profit has dropped here, but I can get back up to this tent. I can make $8,000 or $9,000. And to me, to risk a few $100s for an $8,000 or $9,000 gain, I think that's a good exchange. So this is pretty much going to be the end. So I'm going to move this to next adjustment. And this goes all the way to expiration day. On expiration day here, I can trade or stay in this position all the way until the end of the day, or I can negotiate my way out of it during the day if I'm fairly confident the market's not going to come back into my profit range, which was the case here, and ended up closing the trade out at about an $800 loss. So I come in here the following month. I'm going to do the same, or the following. Now that this trade's closed, I do the same thing. I have an option here that expires 14 days to expiration. 46.60 is about my asset price or at the money. So I sell 10 of those. I buy 10, in this case, 3 days out. I have a little better risk reward here. I have, remember the peak of my tent was at 18,000. It's 22,000 now, and my cost, I guess, is a little bit more also. But this is better, but still, in my opinion, a little bit marginal. And by the way, what happened the last cycle? Well, we had a pretty strong, consistent down move for those 15 days. And here this continues. If I go to next adjustment, I can make this adjustment now and still maintain my positive delta. So I do that. I go to, let me ignore this for now, go to next trade. So it's pretty simple, right? Simple adjustments here, simple moves. I go a little bit further, same thing. I'm getting drawn down a bit here, and I want to watch my maximum risk. I come in here and I pull this down so that if this continues, then I'm only going to take definitely less than a $2,000 loss. And if it hangs out here for a while, it comes back later, then I could make a lot of money. If it whipsaws me too fast, I'm out. So that's basically the way that I'm dealing with this. So if we do this here and we go to next adjustment, I end up getting like a 77-point down move to the downside. And this is my profit and loss here. I did decide to do one final adjustment to this. A lot of times I won't make this last one, but I did with this one here. I just didn't think it was coming back. So I made this adjustment. I maintained my positive delta here, and it made a little bit of a difference in what my loss would be if I were to experience, which I thought was probable by now. And that was that, and that was probably the last adjustment of the trade, I would imagine. Let me go to end here. And this is what we look like by the end of the trade. We're down about $1,400, and we close the position at that. And if you look at the price chart, you can see the market completely lost it here, just boom, all the way down, right? This is a really hard down move. Now, a lot of people at this point are saying, well, geez, I did 2 trades and I lost them both, and at the beginning of the year, and the strategy doesn't work. But that's the thing with trading. What we do is we set up good high probability strategies, and whether the market's going to play to those strategies or not, it probably will. But it goes through periods of time where you might go through a few trades and have a little bit of trouble. But if your risk reward parameters are good and the trading strategy is good, you don't really have to worry about that, because over time, the trade's going to come into play, and we're losing a small amount of money, $800, $1,400. When you look at the potential profits we could be in here, for example, we could realistically make $14,000, $15,000 off this trade. So that's a good combination if you have the probability the trade works out, and in this case it does. So this is closed now. If we go to our next cycle, now we have a trade setup that I like, by the way. So we look at this setup. Remember, the other 2 were marginal. So a lot of times you can tell from your trade setup whether you have a very good probability of making money or winning the trade, or whether you have a good probability of losing the trade. This here I really like. I got about $4,000, $4,200 in the position. Top of my tent here is $32,000. That's like an 8-to-1 risk reward. And like I said, we like the tents nice and high here, so we have a lot of profit potential. These generally turn out pretty well when you get this type of a setup here. So let's take a look at how this one turns out. And this time we're having some trouble to the upside, and we're just doing the opposite. So we're getting some hard up moves, and now I can make this adjustment here and maintain my delta. We're drawing down at 940. And it's important when you're trading, especially when you're trading the short-term strategies. One of the things about the short-term strategies is because they're short-term, you can have many trades in a favorable market environment. In other words, you can do these for a period of, say, 3 months, and if you're doing 1 trade a week, you're winning what, 12 trades. I've won 12 trades. The strategy is wonderful, but But the reality is the only thing that happened is you went through 3 months of a good market environment for the particular trade. But what you have to realize when you're doing these trades is that they also shift to the bad market environment, and sometimes you'll get 3 or 4 trades in that context also. So you want to make sure you do that. I mean, this is a market neutral trade, and this is anything but neutral. We're flying all over the place here. Anyway, the way we're going to manage this is pretty much the same way here. We are going to move these shorts up a little bit, and we're maintaining our negative delta. Let's go to next adjustment. We get another 43-point up move. Again, my objective here is to get this line here kind of under $2,000. I think 2,500 is okay. I like it under 2,000 though, if I can. So I split this a little bit, still negative delta. Now I'm pretty much at my $2,000 number. And then if I go to next trade here, what ends up happening is we end up with a 100-point down move in the index. That is a lot. But I am starting to take on a little bit of downside pressure, and this is getting whipsawed, but from a positional standpoint, it's not bad, right? I just got pulled back here. Profit and losses, it's getting close to where I might want to get out, but it's reasonable. So we're just going to bring this back into here. And like I said, I adjusted because I was too positive delta. I was 1466, and my downside risk was too much if it was going to continue. I came into here and came here. Now, if I get too much downside pressure here, then we're going to just exit the trade. But this is still acceptable to me. So let me go to next adjustment. And by the way, look at the price move. And again, we're short-term market neutral, and this is anything but. So moving forward here, we get the up move. Now we start pulling a little bit negative delta here. So again, I flatten this out. I want to get this into the 2,000 level again if the market's going to continue to go up. We go to next adjustment here. We're 7 days into expiration. Here, again, our delta starts climbing. We go a little bit further, and this is our new position here. So now I'm acceptable on my risk to the upside, and everything's going fine here. And then if I go to next trade here, let's go the day before. So this is where we are on, I'll put it this way, go 2 days before. So this is where the money can come in. If I'm willing to risk losing my $1,800 here or whatever this line's at, which is not very much risk, I have the ability to make a lot more money if I just let the trade play out. So I want to do that. So if I move forward the next day, right, we get this 89-point down move. We're up $3,900. Everything looks fine. My risk to the upside is fine. Like I said, I'm willing to accept that $1,800 loss. My risk to the downside, I don't have a problem until I exceed, back into here somewhere. So no problem at all there. If I go to the following day here, which I have one more day left in the trade, the market does come down into my center of my position, and we end up closing this out at about a $19,000 profit. So, this makes up, and this is why it's important to start getting subjective with our trading to have where it's really nice to have a good risk reward scenario. I was risking essentially $2,000 here, and I had a couple of losses, right? I had a $1,400 loss, I had an $800 loss. That's total of about $2,200 in losses. And then boom, the market does accommodate you once in a while. And when it does, we hit this with 19,000, right? Fantastic. So now out of the 3 trades, we're up, $17,000 in 3 trades. And realistically, this is only a little over a month. And that's on $25,000 planned capital. That's almost 80%. So that's looking good. So anyway, I have to get out of this because, it's expiration time. So I'm going to exit. And again, I look at this setup here on entry. I have $4,000 costs. I have a $32,000 potential gain. That looks nice to me. And if you look at the options, again, we're 14, in this case, 17. So we've got a 3-day spread, 14 days maximum in the trade. If I move forward now and go to my next adjustment, what happens is in a very short period of time, I hit the volatility right, so a little luck going on there. But in 7 days, I didn't have to make any kind of moves here, and I'm up about 20 $580. Everything's looking good. My delta is getting a little high. I don't like that. Or my risk to the downside is getting a little high, so I don't like that. So I'm going to come down and I'm going to just make a correction. I'm still positive delta. Everything is fine here. And, when I am actually up money like this, I can really pull my risk out of this pretty nicely and, without making too many adjustments. So that is there. And let me go to the next adjustment here. I go to the 27th. Again, we're ranging in this range here, and our delta is getting a little high. I can come in here and I can bring another 5 contracts down. I'm still positively positive delta, or solidly positive delta here. And this is what our position looks like. It's like it's coming together nicely. And this is more normally how they go. They normally go a little bit more like this. And then if I go to next adjustment, right, that's going to end up closing the trade. So let me just ignore this. And what ended up happening, we ended up having a big up move into the day where we were going to expire this, and we ended up taking a profit of $8,610. So now we're up approximately $25,000 on $25,000 point capital, or 100% in a little over about a month and a half here. So that's pretty nice when you can run those kind of numbers with your strategies. Now, here it's time to go into another trade. When I was looking at my charting and so forth and what the market was doing and the speed the market was going, and my thoughts on my technical analysis, I mean, one of the things we do in our pro membership is we have this thing called market outlook, and I lay out where I believe the market's going to go. And once we understand where the market's likely to go, we can decide whether or not we want to get into certain types of trades, because the probability of them working out might be good or might be bad. I didn't like the market on this day for entering a trade. So what I ended up doing is I ended up going a few days in advanced here, and I went to March 1st. And I liked this, where we were technically in the market at this place, better. You can see we started to range out a little bit here. And I said, okay, good. Because our concern, whenever we have a capitulation like this in a market outlook, our concern is the market's coming back up here. And we were expecting that kind of price movement. We don't really want to do that. But this flat day and then the down day here kind of negated that. So I come in here and I like this positioning a lot better. And this time here I have a 15-day expiration, and I have a 17. That's a 2-day expiration. That's fine. I am using the AM options. I would not put the short strike in the AM options, but I'm perfectly fine putting the long strike in the AM options because I'm not going to expire it anyway. So this is our new entry here, and that's on March 1st. And then if I go to next adjustment there, we had a bit of a down move, and again, taking on some delta, came in here, 5 contracts, still positive delta, that's fine. And then that is the 7th, and today's the 9th. So if we go to the 8th here, this is what we look like on the 8th. No adjustment necessary. This is fine. And then if we go live here, we're up 122 points in the SPX today. That's a monster move. But our position right now is up. Well, it bounces around, but it's up somewhere between $1,500 and $1,900. It's looking really, really nice. And this is where we stand as of right now. How is this trade going to work out? I don't know. I mean, it could be a big winner, it could be a loser, but that is the advantage of calendar spreads in certain types of market conditions. So one of the things I'd love to share with you is we're having a special webinar about trading calendar spreads for income that's going to be held on the 17th. And what you should do is go on over to lockeinyoursuccess.com. That's LOCKE in yoursuccess.com. And when you do that, you should get a pop-up box that looks just like this, trading calendar spreads for income. Click here to register and to join this free webinar. You come in, you click there, and you complete the registration process, and you'll be invited to the webinar, and you'll get to access the recording for a limited time. I'm just really excited about the conditions for calendar spreads, especially these shorter term calendar spreads in this environment right now. And on that presentation, one of the things that I'll do is I'm going to come in here and I'm going to show you the result of the calendar spread that we've been showing you today. And that is our somewhat subjective short-term short spread calendar strategy. If you like what you see, I encourage you to come on over to lockinyoursuccess.com. That's LOCKE-in-your-success.com, and discover how you too can follow along with many great strategies as they unfold during our weekly Options Trading for Income webinars, where we cover 12 non-subjective trading strategies. Or of course, if you're a pro trader, you can join our pro membership, where we cover all types of different types of trading strategies that produce income long-term for our traders. Also, if you go to thewinningtrade.com, you can learn about upcoming winning trade presentations. You can explore past winning trades, and you can also find out about our free trading performance podcast, where you can learn to skyrocket your trading regardless of the type of trading you do. If you have any comments, questions, or anything you'd like to see on the next winning trade, please make sure you post them in the YouTube video comments, and I'll answer your questions and comments for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade. And for those of you interested in calendar spreads, I look forward to seeing you on our Trading Calendar Spreads for Income webinar on the 17th of March. Thank you, and I look forward to seeing you soon.